Good afternoon and welcome to the February 28th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy, and I am so happy to be joining you here today to answer your student loan questions. And I just want to say before we get started, thank you to everyone who submitted questions to us, because if you have the question, chances are somebody else does have the same question as well. And it's our pleasure to bring clarity to this student loan space. So as always, I want to start this episode by telling you a bit about the center so that you know where McFew came from. So the center was founded in July 2021 with an ambitious vision for all of Maryland's college and career school students. And that's that they would be able to achieve these 6 pillars of collegiate financial wellness. Those are being credit-worthy, ready, resilient, empowered, successful, and thriving. If this sounds like a vision or a mission that you'd like to support, please do visit us online at mccfw.org, where you can learn more about the Maryland Center for Collegiate Financial Wellness, as well as our many programs and opportunities for you to support. So please visit us at mccfw.org/support if you would like to get on board with our mission and vision. And before we get into the questions from today, I just want to make sure that I share with you a quick disclaimer. That is that Office Hours is presented for informational purposes only. The information presented does not constitute personal, legal, or financial advice. Now, we do our very best to give you the most up-to-date information possible when it comes to student loans, but if you've been paying attention for the past few months and even for the past couple of years, you've seen that a lot of changes have been made. So we're basing the information presented today on the information that we have seen as of up to last night. So just keep in mind, before you make any decisions about your personal situation, you want to make sure that you take into account your loans, your servicers, your household income, your career goals, plenty of things, so that you have holistic solutions. All right. Let's move on to updates. We've had a lot going on over the past few weeks. One big thing is that we're continuing to see these PSLF victories come in. I was just able to connect with a student affairs professional yesterday who actually attended one of our events in December. And this person might have experienced the fastest PSLF victory that I'm aware of, at least in my experience working with borrowers. They attended a webinar in December, completed most of the paperwork then, followed up with a little bit more paperwork in January, and yesterday received their congratulations letter. And that's a 6-figure debt now lifted off of this person's personal balance sheet. So congratulations to all of you that are hearing that congratulations message and just seeing your student loan debt eliminated. You have earned it. You worked hard for it, at least 10 years worth of work in public service and 10 years of repayment. And we congratulate you on the success. And we really appreciate you allowing the Maryland Center for Collegiate Financial Wellness to be a part of your journey. I also want to give a shout out to Prince George's County Sheriff John D.B. Carr. We are so appreciative for the opportunity to visit the sheriff's office in Upper Marlboro yesterday and help county government employees get on track for public service loan forgiveness. We had a really engaged group, had a lot of questions, got a lot of PSLF applications approved on site, and I'm just very hopeful about some of the outcomes that we're going to see for these borrowers who are public servants here in Prince George's County within the next few months. I also wanted to share on the policy front, things are moving quite a bit in Annapolis right now. We are deep into this year's legislative session, and McFew is supporting 3 bills this year. HB 708, which is about institutional debt and how institutions go about collecting debt from a student. This is not student loans. This is when a student actually owes a balance to their college or university, and trying to set up mechanisms for the institutions to report on that debt so that we can take a look and see if there are any patterns in who's affected by the debt, and also how that debt is collected. So that's HB 708, and we're thankful to Delegate Leslie Lopez for sponsoring that bill. We also supported HB 811, which is a financial well-being bill aiming to create a pilot program at both Morgan State and the University of Maryland College Park. So the students there, the students who are financially at risk the most, would be able to have access to professional, unbiased, and trustworthy financial well-being support right there on their campuses. And thank you to Delegate Wolak for sponsoring that bill. We also have a hearing coming up next week, March the 5th, for HB 1172, which is a bill that would increase awareness of the Public Service Loan Forgiveness Program across the state, and also make clear the guidelines so that our colleagues who are adjunct faculty members can make sure that they're getting the maximum amount of credit toward public service loan forgiveness so that they too can be rewarded for their service. On the event front, please save the date for March 23rd, 2024. Our partners at the Cash Campaign of Maryland are hosting Money Power Day. And if you're not familiar with Money Power Day, it is the largest financial fitness fair in the state of Maryland. It's happening March 23rd at Poly Western High School in Baltimore, Maryland. So we are happy that Money Power Day is back in person, and it will be our pleasure to be there, not only as workshop leaders, but also we'll have a booth there. So if you're in the area, please do stop by and visit the center on site at Poly Western High School on March 23rd of this year. All right, now that all of that is out of the way, I think that we can get into the questions for the day. So let's take a look at question number 1. All right, the first question is, can the SAVE plan help me? Is it even worth applying for SAVE? So as with most questions, it depends. It depends on your loans. It depends on your situation. So let's take a look at how to help people figure out if SAVE is worth applying for. Before we get into answering the question, I just want to make sure that people know that there is a tool called the Loan Simulator where you can go to estimate your payments. And that's, of course, our recommendation. But I also want to provide you with some background first. This person says that along with their spouse, they're making more than $200,000 per year. So they weren't really looking to go on a payment plan, but they heard that SAVE subsidizes the interest. And the question is it worth applying just for that? They started out with $100,000 worth of loans, and they currently have $21,000 in loans remaining with an average interest rate of 4.3%. So again, my advice before anyone switches repayment plans is to go to studentaid.gov and use the loan simulator, because that way you can log in. Your loans will be used in the simulator so that you can see what your repayment options are under the different plans. So let's take a look at the results for this person. All right, so the picture that you're seeing here is a comparison of how much the person would pay under income contingent repayment, the standard repayment plan, and then saving on a valuable education. And this isn't the monthly payment. This is the overall amount to be paid. This is based on income of $200,000, loan debt remaining of $21,000, and the interest rate that was in the simulator at the time was 5.5%. We're also assuming that whoever this borrower is, they don't have any dependents. It's just them and their spouse does not have student loans. So if you take a look at the overall amount to be repaid, you'll see that SAVE is the plan that the Department of Education actually recommends, because the total amount to be repaid overall is less under SAVE than it is under income contingent repayment or the standard repayment plan. This gives the overall picture, but I think what we really need to do is take a look at the monthly payment, because the monthly payment will help you decide if this plan is feasible or not. So let's take a look at the monthly figures. All right, so if you take a look at this might make up your mind for you. So the first column we have is the income contingent repayment plan, which, just like SAVE, is based on household income. But when you look at the numbers, you'll see that there's a big difference. So the income contingent repayment plan has an estimated starting monthly payment of $287. If you look on the far right and take a look at what the payment would be under SAVE, that is the new version of Repay, and SAVE stands for Saving on a Valuable Education. That monthly payment jumps to $1,297. And for some people, it's hard to reconcile, like when you hear people talking about SAVE and how SAVE is the most affordable repayment plan ever, and then reconciling that with the numbers that you see here. If you saw $287 versus $1,297 on any other bill, you would of course, say that that $12.97 is anything but affordable. But this is why it's so important to use the simulator, and also never underestimate the value of strategy or the importance of strategy when you're trying to figure out how to repay your student loans. So with income contingent repayment and save, both of them are based on your income. And for most people, income contingent repayment is the least affordable repayment plan because the formula uses 20% of your disposable income instead of 10. But there are some cases where there's an alternative formula for figuring out what the monthly payment would be under income contingent repayment. And that alternative plan or alternative formula is often used when a person has way more income than debt. So in this case, we have a person whose household income is more than $200,000, but their level of debt is only $21,000. And because those values in comparison are so lopsided, the alternative formula for income contingent repayment was used, and that resulted in the payment of $287. With SAVE, there's only one formula. It's a maximum of 10% of your disposable income. And if you have income of $200,000 per year between you and your spouse, this income-driven repayment plan is looking at that income relative to your $21,000 worth of debt and basically saying you have enough money to pay this debt off pretty aggressively. So with SAVE, 10% of this person's disposable income is estimated at nearly $1,300. Now, if you're trying to figure out which plan you want to use to repay this debt, when you compare 287 to 1297, that might make the decision for you. We got to keep in mind, though, that this borrower has already been in repayment for a while. And when the question was submitted, we did not see what their current payment is. So my advice to this borrower would be, of course, use the loan simulator so that you can see what your options are. But then you also have to look at your personal budget. Can you afford $287 or can you afford $1,297? The formulas say that you should be able to afford it, but practically speaking, what does your budget look like? For me personally, $12.97 would not work. I don't think. But again, that's a very personal choice. You have to look at the options that are available and choose the one that makes the most sense for you. Now, the person that posed this question, what they were truly getting at was the value of the interest subsidy, because SAVE comes along with a provision that if your payment is too low to cover the interest that's accruing each month, SAVE has a provision where the federal government will cover that excess interest. But the issue here is that on a $21,000 debt, if someone is paying $1,297 per month, we know right away that that basically $1,300 payment is high enough to cover any accrued interest. So if the only reason that this person is looking at SAVE as a potential option is that they're looking at the interest subsidy, the interest subsidy would not help them anyway, because their payment under SAVE would be far larger than the amount of interest that's accruing each month. So I'm thankful that this person included details about their household income, the amount of debt that they currently have, and even their interest rate, so that we could use that to give them a more personalized answer, because generally speaking, SAVE is the most affordable plan. But as you saw in this example, when someone has relatively high income along with relatively low debt, that could make income contingent repayment, which is also known as ICR, a more affordable option. So go to the loan simulator at studentaid.gov, and that way you can log in and see which options might make the most sense for you. All right, I think we can move on to the next question now. All right, the next question is, I have less than $8,000 of loan debt. Should I pay this off now when interest can be written off in taxes? That's a good question, but that's also another one where we have to do some math to figure out what the best advice is for this particular borrower. So let's dig into the answer. They have mentioned, this is very helpful, the timing, that they have 3 more years of payments, and they want to know, would I save any reasonable amount by paying them off today? So I recommend the same thing that I recommended for the borrower in the previous example, and that's to go to studentaid.gov and take a look at that loan simulator to see if there would be any additional savings by enrolling in the SAVE plan to use the interest subsidy. But there's another factor that I want to mention, and that is cancellation by way of income-driven repayment. If this borrower only has 3 more years of payments, that means that they might have been in repayment for a while already. And SAVE has a provision that allows people who have borrowed less than $12,000 overall to have their remaining debt canceled after 10 years of repayment. We don't know how much this borrower originally borrowed. We don't know how long they've been in repayment. But if they enroll in SAVE, then they can be considered for that cancellation. And we can also make sure that they have direct loans or federally held loans so that they can be included in that IDR adjustment payment count. So the motivation for SAVE might not actually be the interest subsidy, but it could be cancellation, depending on how much they originally borrowed and how long they've been in repayment. Now, SAVE also has that interest subsidy, but it really depends on your household situation, how your income stacks up against your debt. There could be some interest savings during your final years of repayment, but we're not able to figure out what those savings could be without knowing what your payment would be on the SAVE plan. So you definitely need to go to studentaid.gov, use that loan simulator so you can find out what your payment would be under SAVE. If your payment is higher than the amount of interest accruing each month, then the subsidy is not going to make a difference for you. But if you're one of those borrowers who comes back with a payment that's like $0 or $5 or $10, then you know that SAVE would help you out because that interest subsidy would kick in to cover the excess accrued interest. And if you're able to pay down the debt faster, there's no prepayment penalty on federal student loans. So you might be obligated to pay $5 a month, but if you have the extra cash, you could pay that debt down early while taking advantage of the interest subsidy at the same time. So go to studentaid.gov, use the loan simulator, estimate what your payment would be under SAVE, and that's what would help you make the decision about whether SAVE is worth enrolling in. The other thing I want to mention is that the person also has brought up the fact that student loan interest can be written off on your taxes. It can be, but that's subject to income limitations, and it also depends on how you file. I believe that deduction is one that disappears if you are married and file separately. So for that, I would go to whatever tax prep software you use, or perhaps if you use a professional preparer, just reach out and ask the question, because if you're thinking about doing this just for the tax benefit on interest deduction is a maximum of, I believe, $2,500. And you might not have paid enough interest to get all of that $2,500 as a deduction. So we need a bit more information to answer this question, but common theme here is go to studentaid.gov, use that loan simulator so you can see what your payment would be under SAVE, and then you'll be able to decide whether it makes sense for you to pay down the debt aggressively or stay in the plan that you're in, or enroll in SAVE and use a combination of those activities. So thank you for the question. I hope this has given you some food for thought. And if you have more details to share, we're open to hear them so we can help you make your choice. All right, let's move on to the next question. And that is, my dad died. How do I find out what types of loans he took out? And do I still owe for these loans? How do I access the loans to pay? First things first, I would like to extend my condolences to this borrower on the loss of their father. And that's a lot to deal with on its own. And sorting through finances and all of that stuff is another level of, it just kind of adds on to the grief, or at least from my perspective, it does. So I just want to send you some encouragement for what you're going through, and hopefully some insight to help you work through this process so that you can get rid of this debt. So let's take a look at the answer. That is, we've got some more details first. They're trying to figure out if they owe for the loans that their father took out. When the borrower goes on their own personal studentaid.gov account, it says they've seemingly been allocated the student loans that their father had taken out. All the loans are described as subsidized and unsubsidized, but they want to confirm that the loans are not Parent Plus loans. And to confirm that, where should they go? So first, I just want to make a general point here that all federal student loans can be discharged upon the death of the borrower. So if the student passes away, the student's loans can be discharged. If the parent who took out loans passes away, then those loans can be discharged as well. It's not an automatic process, but it can be done. Um, More particular points about this question. Some detail in here mentions that all the loans that the student can see in their own account are subsidized and unsubsidized. If you're seeing subsidized and unsubsidized loans inside of your studentaid.gov account, that means that those loans are yours, because Parent Plus loans have their own title. They're Parent Plus loans. And if you're seeing loans inside of your own account that don't have, Parent Plus there in the naming, then that means that the loans are yours, that you took out for your own education. So it wouldn't be that loans that your father took out were reallocated to you, because with federal student loans, you can't transfer the debt from one person to another. So if you're seeing subsidized and unsubsidized federal student loans, that means that those are loans that you took out for your own education. To gain clarity on this, I would recommend reaching out to the school that you were attending when you and your dad borrowed the loans, because the school will have records of all the loans that are borrowed. And the school can also tell you what information you need to submit so that the school can go ahead and contact the Department of Education to provide proof of death, and those debts can be discharged. So again, studentaid.gov is a great place to go to see your own loans. If you don't have your father's account credentials for studentaid.gov, then you wouldn't be able to log in there. But the school has the history of all student loans that were borrowed for you as the student. So that's the place that I would go, definitely, to get clarity around the situation. And again, my condolences for the loss of your father. All right, let's move on to the next question. And that is, my dad doesn't have income. How can he apply for a more affordable income-driven repayment plan? So let's take a look at the answer to this question. We're going to need much more detail before we can answer this question, though. So here's the detail. My dad doesn't have tax returns to use for applying for income-based or income-driven repayment plans. And he doesn't have W-2s to get him unemployment for the unemployment deferment. He's stuck on the standard plan that neither one of us can afford, and that payment is $600 per month. Can he get on an income-driven repayment plan? So the issue of income documentation is one that is only felt by people who are attempting to enroll in income-driven repayment plans. So went straight to the Department of Education so that we could find out how to report income. For this time where we are out of the pandemic, the Biden administration has chosen to leave some flexibilities in place, and one of them is around how you can certify your income. So as per the Department of Education just last night, this is their language: for a limited time, borrowers can self-certify their income by providing a document stating their income. When completing the request, and that's the request for an income-driven repayment plan, they can select the "I'll provide my own income documentation" and select that option, and then upload a PDF or text document that includes that information. So all of that is a long way of saying you can just report your own income. You don't have to have the W-2 or pay stub or any of that other alternative documentation. You can get on Word, type up a quick document stating what you've earned, and then upload that document online through studentaid.gov when you're submitting the IDR request. That is a limited time option. That's not something that's just going to go on forever. The idea is that you're accurate, and by self-certifying, of course, you attest that you are telling the truth. And if your father has no income, he could type that letter, use that as documentation of his zero income, and then get enrolled in an income-driven repayment plan. And I'm going to assume that since he has no income or no reportable income, that he'll also have a $0 payment for income-driven repayment. I wanted to share a bit more detail about this question, so let's move on to the next part of the answer. I just wanted to share what needs to be in that document to self-certify your income. Of course, you want to include your name, Your tax filing status is going to determine what else is included. If you're single, you want to put in your yearly gross income. If you're married filing jointly, you'll need to provide your income as well as your spouse's combined yearly gross income. And if you're married filing separately, you want to include just your yearly gross income. Now, some other information from this question that we had was that the father is not married. He has a girlfriend, but since they're not married, then the whole tax filing status, that part doesn't apply here. The father is single. He would just report that his gross income is zero along with his name, and this should be acceptable just for now because we still have those flexibilities that were attached to the COVID-19 pandemic. All right, so let's move on to the next piece of this answer for a bit more detail, just to show you what that sample communication, the next piece will show you what that communication looks like, but I just wanted to add a bit more detail here from the Department of Education on how to report your income. This is, again, their language from last night. If you don't have income or you receive only untaxed income, you can indicate that in the online or paper application for an income-driven repayment plan request. In this case, you're not required to supply further documentation of your income. So again, if there's no income to report, you don't have that alternative documentation or that burden to provide that alternative documentation. So I'm hopeful that this person's father can submit the language that's on the next part of this answer so that they can get enrolled in income-driven repayment and hopefully get a $0 payment, because if you got no income, then there's no way that you can pay. All right, so this is an example of the document format provided straight from the Department of Education's Help Center at studentaid.gov. And the question this was answering is, how do I self-certify my income in the income-driven repayment application? You can type your name in print, type your yearly gross income. And for this person, it's just their income because he is single. Add the family size and the date that this form or this letter is being submitted, upload that, and hopefully that will be enough proof that there's zero income. He can enroll in the income-driven repayment plan and get on track with a $0 payment. Now, in future years, this could present an issue. This self-certifying option is not something that's supposed to be permanent. So if the father continues to earn zero income, there is a process of recertifying income that has to happen. And if there's no documentation to provide, I'm not sure what the servicer will say. But my advice is to go through studentaid.gov because that's the Department of Education, and ultimately they're the ones who dictate these rules. Go straight to studentaid.gov, upload this statement from the father, just as the language is shared here, and then see what happens with the income-based repayment application. All right, let's move on to our next question, which I think is in that same vein of self-certifying income. So this question is, my employment has changed. Can I update my servicer with my current self-employment income? Yes, self-employment. This can get, I don't want to say tricky, but it's a little more complex when you're self-employed and you don't have the same steady revenue cycle as you would if you were working like a regular full-time job. So let's take a look at how people who are self-employed can satisfy the information requirements for applying and recertifying their income-driven repayment plans. So a bit more background first. This person is starting a business in a few weeks and they owe 6 figures in student loan debt. Their current payment is about $1,300. They're trying to recertify their income to reflect how much they earn now rather than their income from the previous tax year. The servicer keeps asking, they've said the servicer keeps asking for my adjusted gross income from my last tax return. Has anyone successfully been able to get their income recertified to reflect current income before becoming self-employed? If so, how? Okay, so my first recommendation is to go to your studentaid.gov account instead of dealing with your servicer. And that way you can go straight to the IDR application. Within the IDR application, they're asking you if you've filed your taxes or in the most recent 2 years, and if that information can be transferred from the IRS into their application. There's also a question about whether your income has significantly declined since the last time that you filed taxes. And of course, If you have left your full-time job and you are, ready to start this business, or if you've left and just have no income, then your answer to that question would be yes. Once you answer yes to that question, another question will pop up, and that will be for you to provide a documentation about what your new or current income is. And during this special period where self-certification or self-stating your income is allowed, you could just do that with a personal statement. That's that letter that has your name, your income, depending on whether you're single, married, filing jointly, married, filing separately. You might need to provide some information for your spouse, and the date that you're submitting that letter. So you could use that option to begin with, but for future years, you're going to need to be able to document your income. So the next part of this answer talks a bit more about how that works for self-employed people. And that is, there are other acceptable forms of documentation of income outside of a W-2 or your tax transcript. If you have like a signed statement from your accountant that shows your income recently, if you do have pay stubs for your own business, or you can also self-certify via statement for a limited time. But trust me, as someone who's been self-employed for a while, this the income definitely ebbs and flows. But when you're going through this process with the Department of Education, you want to make sure that you meet their requirements for I don't want to call it the burden of proof, but you meet their requirements for what's acceptable documentation of income. For a limited time, that could just be a simple statement. But in the future, you want to make sure that you can document your recent income. You don't want to send them something that's a year old, because they're not going to accept that. Your recent income, either by way of a pay stub, signed statement from an accountant, or if you have contract work that you're working on, you could submit that documentation to, just to show them that your income, that you have income, but you want to make sure that the amount of income that you're showing them accurately reflects your current or at least very recent situation. All right, let's move on to the next question. Okay, that question is, I'm applying for SAVE. Should I consolidate all of my loans? Is this beneficial? This is another one of those ones. It really depends. It depends on how many loans you have, the types of loans you have, and also when you're looking to take action, because we are working with a deadline of April 30th of this year for the income-driven repayment adjustment. So let's take a look at the first part of this answer. All right. So again, I'm applying for SAVE. Should I consolidate all of my loans, or is there any benefit in only consolidating my FFELP loans? That is key information right there, the loan types. So we're in this special period until April 30th, where people can gain more credit than ever toward both income-driven repayment cancellation and public service loan forgiveness. But there's certain types of loans that are going to be left out of this. If you have commercially held FFELP loans, then your loans will not be included in the income-driven repayment adjustment. And if you have anything other than direct loans, your loans will not be considered for public service loan forgiveness. So for a bit of background, this borrower has 8 direct loans and 3 FFELP loans. We did not receive any timing on when these loans were taken out, but what we're going to assume is that the direct loans were from one educational experience completed at the same time, and the FFELP loans are from another educational experience that probably happened earlier. If these loans are left the way that they are, we know for sure that clock 1, that includes those 8 direct loans, that clock will be counted when it comes to the income-driven repayment adjustment. On the right side, you have clock 2, which includes those 3 FFELP loans. Because we don't know what type of FFELP loans those are, we don't know if that time is going to be counted toward the IDR adjustment. So for this person, if you leave those loans the way that they are, the only loans we're sure that will be counted for the IDR adjustment and public service loan forgiveness, if that's an option, would be the 8 direct loans. Those 3 FFELP loans are questionable because we don't know if they're federally held FFELP loans or if they are commercially held FFELP loans. So the next slide will show you what my recommendation is. Because we are in this special period until April 30th of 2024, if this person wants to maximize their potential for cancellation, then they should consolidate all of these loans together. We would go from having one group of 8 loans and one group of 3 questionable loans to one group of 11 loans that will all be counted for credit toward income-driven repayment cancellation. If you have any commercially held FFELP loans in your student loan portfolio, you have to consolidate them so that they can be counted in the IDR adjustment. And you want to make sure that you complete the application to consolidate at studentaid.gov only. You want to complete that application by April 30th of 2024 to make sure you're on track to benefit the most. If you have federally held FFELP loans, they will be included in the IDR adjustment. But generally speaking, FFELP loans are older than direct loans. I've seen some direct loans that are pretty old, but for the most part, when we see a borrower who has both FFELP loans and direct loans, the FFELP loans are usually older. And with income-driven repayment, you get to cancellation by having more history. So if your FFELP loans have more history than your direct loans, the best way to make the most of this opportunity would be to consolidate all of those loans together. So if this person had 8 direct loans, 3 FFELP loans, the way to maximize their benefits toward cancellation would be to take all 11 loans and consolidate them together into one new direct consolidation loan. That way, all 11 loans would be on the same repayment clock. And until April 30th of this year, that repayment clock will be based on the one loan that has the greatest amount of history. So if your FFELP loans are from like 2002 and your direct loans are from 2015, if you consolidate those loans together, all of them will get sped up to match the pace of the loan with the most history in the portfolio, which is probably one of those FFELP loans from 2002. So in a nutshell, to me, it would not be useful to just consolidate the FFELP loans, because that would help them become direct and they would be included in the IDR adjustment. But you have those other direct loans that are sitting separately that would be on another repayment clock. And that repayment clock might take longer to get to cancellation. Whereas if you put them all together, they'll all be on the same clock and you could speed up the pace of forgiveness on your more recent loans. Now, of course, we would need more details to look at the timeline and figure out, if this would be worthwhile. But for the vast majority of people in this situation, the FFELP loans are going to have more history, and your more recent loans can take advantage of that history to get closer to forgiveness by consolidating all of the loans together and getting them on the same repayment clock. All right, let's move on to the next question, which I think is the last question for today. All right, this question is about public service loan forgiveness. It says, my count is really low and I have more than 10 years of employment. How can I tell if all of my employment is verified? This is something that we are seeing a lot of. We've got people who have been in public service for, 15 or 20 years, but they're coming back with these counts that are like 20 or 30 months. Or one person in particular I'm thinking of has 15 plus years. We submitted the paperwork for 2 employers, but the count has been sitting at like 55 or 56 for several months now. So if you know that you have turned in your paperwork and the math just doesn't look right, the good thing is you can go to Mohela.com and you can log in and you can take a look at every employer that they have a record of, as well as the dates that your employment has been verified for. So let's take a look at the answer for this question. So 2 ways to do this. You can go to Mohela.com and on that navy blue navigation bar, you can click PSLF and then click on the payment tracker. And I'm going to show you what that looks like on the next screen. But the other thing you can do, which I probably wouldn't recommend, but I just want to let you know it's an option, is you can log into studentaid.gov and there's a My Activity section that you can take a look at, and that will show you if your employer has signed your PSLF application. So at least that way you'll know if they signed it, because if they did sign it, that means that it's gone to Mohela and Mohela is definitely counting it. But the first place you should go for sure is Mohela.com, because in Mohela, you'll be able to take a look at all the employers that have been certified. You can also see the months for which those employers have been certified. So let's take a look at what that screen looks like at Mohela.com. All right, so this is a screenshot from Mohela. If you take a look at that navy blue navigation bar going across the top, PSLF is the space that we concentrate on. And when you click on that little arrow next to PSLF, it gives you a drop-down menu, which should include the payment tracker. If you don't have the payment tracker available just yet, it might be because you're new to Mohela, and sometimes it takes a little while for you to get full access. But once you have access to the payment tracker, when you get to the payment tracker page, it's going to be a lot of text, like 4 or 5 boxes of text, like this update on regulation changes to the PSLF program. Scroll past all of that, and you're going to see 4 blue tabs. One is payment counts. The second is eligible payments. The third is ineligible payments. And the fourth and final one is employment. You want to click on the employment tab. And once you click on that tab, you'll see like a box expand that shows you every employer along with the employment begin date that they have on record and the employment end date that we have on record. Now, for the borrower that I mentioned before that has more than 15 years of public service experience, but their payment count has been sitting at 56 for the past 6 months, that's because one of their employers was not included on this list. Their PSLF application was submitted last year before the electronic version became available. And because they submitted the form on paper, as they should have because it was the only option, they mailed it. And there is apparently no record of that application with Mohela. So once we saw that, we knew right away, we've got to get this PSLF application in for the second employer. So we went to studentaid.gov/PSLF, completed the form using the PSLF help tool, and this time we used the electronic version. So that instead of having to print out the form and get it signed, they were able to just put in the email address of their organizational contact, and hopefully that form will be signed soon and make its way to Mohela. And since the electronic forms are getting reviewed, at least from what we see, a lot faster than the paper forms, I'm really hopeful that this person will have their debt cleared up within the next, I hope, 4 to 6 weeks. We'll see what happens. But this is really the difference maker between 56 and a number that should be well over 120 qualifying payments. So I'm claiming it. This is another PSLF victory in the making. Just need this paperwork for the last employer to go through. All right, well, that does it for our questions today. So before we go, I did want to share a resource at the state level for student loan borrowers, especially those of us who are in the state of Maryland. Maryland is a state that has a student loan ombudsperson. And the student loan ombudsperson's office can help you in many ways. This is a list here. They're there primarily to help you with issues that you might be having with your student loan servicer. And those issues might include failure by the servicer to communicate with the borrower, errors in crediting your principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidation or modification errors, and or inappropriate collection activity or tactics. Little screenshot that you see there is from the ombudsperson's office within Maryland's State Department of Labor. So you can visit them online to find out more about their services or ask for their help, and perhaps they might open up an investigation to help get you resolution. Before you reach out to them, though, I would recommend trying in good faith to solve your issues with your loan servicer, because your servicer is your point of contact for billing and everything. Try them first. And if you find that you cannot get a resolution, then you might want to engage the ombudsperson's office at the state level. You could also do that through the Department of Education if your issue falls into a very specific set of criteria, but you have options here. You could also file a complaint with the Consumer Financial Protection Bureau. The biggest thing I want you to know is that you need to advocate for yourself, and you have plenty of options for advocacy. You can also tag us so that we might be able to lend you some support. All right, I think that does it for office hours. I want to take a moment just to thank you all for joining us for this edition of Office Hours. This is the February 28th edition. We are online, live, semi-monthly. So most months that's on the second and fourth Wednesday afternoon at noon, live, answering questions that have been submitted to us via social media, or email, and we also will take questions as we see them come through in the comments. So if you do have any questions that come up, please do reach out to us. You can tag us on social media at the MCCFW, or submit your question through our contact form on our website, which is mccfw.org/contact. And if you submit a question, you very well may see it answered here on the next edition of Office Hours. We will never share your name or any identifying details when we're answering your question. If we do answer your question, we will make sure that we reach out to you to share the video with you so you can see the answer. I'm just going to check the comments very quickly. I don't think we have any questions. Give me a moment. All right. I don't see any questions that have come through, so I'm hopeful that we have answered all the questions in a way that allows people to go forth and at least have some more food for thought in making more informed decisions about how to handle their student loan debt. I'm going to give it just a few more seconds to see if anything comes in before we log off, because we're usually on for 1 hour from noon to 1 p.m. So I've blocked off the hour, but if you all don't have any questions, I'll take back my 14 minutes. All right, let's see. Okay, we've got a query to discuss loans, and that's something that we can do offline. So for that person, I'll make sure that I send them the link to the contact form so they can either send a question or schedule a pro bono appointment. And I don't see anything else at the moment. All right, so if no other questions are there, we are going to wrap up this edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. Again, my name is Dr. Tisa Silver-Kennedy. I'm the founder and executive director of the center. I thank you so much for your engagement, for sending us questions. For those of you who have made donations, thank you so much. Your support, it really helps us to make sure that we can keep the services that we do offer to borrowers offered free of charge. So every little bit makes a difference. If you'd like to support, you can go to mccfw.org/support. I see one comment that says, thank you for the webinar. Thank you so much for joining us today. I really appreciate that. And thank you for leaving some feedback. There's more fuel to keep on going. As always, these videos will be annotated and uploaded to our YouTube channel, which is at the MCCFW. And once they're annotated, we'll, of course, share the video on YouTube so that if you want to go back and look at the questions, you can go straight to the content that matters the most to you. All right. So I think that does it for today. All right. Thank you so much again for joining us. We will be back during the month of March for another 2 editions of Office Hours. If you have questions, please do feel free to reach out and we'll do what we can to help. And until next time, be well. Bye-bye.